Good afternoon and welcome to the HRQ Quarterly Economic Insight Series. I'm Sal Vergara, Vice President, Strategic Partnerships here at HRQ. These quarterly economic webinars were developed to help companies not only make sense of the often conflicting data in today's market, but also gain perspective that can help organizations build resilience and take advantage of emerging opportunities. You just saw the breadth of what Landrum HR and HRQ delivers to our client partners every day. So please let us know if we can be an extension of your HR team to support any of your human capital initiatives. A recording of this webinar will be sent to everyone who registered. Please feel free to ask questions using the question pane in the control panel. There'll be a quick survey that pops up as you exit the webinar today, and we'd certainly appreciate your feedback. It's my pleasure to introduce to you Brian Wilkerson. Brian is the head of HRQ's consulting service line, and he's a frequent invited speaker and sought by the press for his insight. Brian is known for his innovative strategist and has applied his cutting-edge planning techniques around the globe, where he's become known for helping companies gain an edge through counterintuitive strategies. He's authored a number of articles and book chapters in his area of expertise, and he's held senior leadership roles in both large enterprises and global consulting firms, and he's also a successful entrepreneur who has founded and sold multiple companies. Without further delay, I'll turn it over to you, Brian.
Thanks, Sal. Good afternoon, everyone, and thanks for coming to the latest installment in this series. This is going to be an interesting discussion. It could certainly go back to the old adage of it was the best of times and the worst of times. Sal mentioned the often conflicting data that we try to sort through from an economic indicator perspective, and this webinar will certainly be no different. Lots of things going in lots of different directions and lots to sort through. So without further ado, I will jump into it. Usually, I don't know why this is, but it seems like we always do these webinars right when the preliminary estimate for the next quarter comes out, and today is no different. So the summary that I can tell you is that GDP growth slowed in Q3, and I'll talk about that a bit, but the preliminary estimate that came out this morning actually shows it accelerating in Q4. When you look at the Q3 data, real GDP was basically at a 2.3% increase over the second quarter. So a slower growth rate than we had seen in the previous couple of quarters, and that it was more of what we would call or what we anticipate as a normal growth rate. We started to see growth back to pre-pandemic levels. A lot of that was driven by increased business and consumer spending. When you look at where the growth actually came from. Total government spending actually rose slightly as well. Net exports decreased in that quarter, and I'll talk about what they did for Q4. When you look at the Q4 estimate, it was actually up quite a bit. Preliminary estimate is a growth of 6.9%. That saw a significant reversal in the trend around exports. We had been sort of declining in exports for quite a while, and we saw a pretty significant increase in those, or projected a significant increase in Q4. We also saw accelerated investments in inventories. Probably not surprising given the supply chain challenges that we've seen, and I'll talk about some of that data later, but a lot of organizations started to increase their inventories given some of the challenges they have there, and we did see continued increase in consumer spending. So while we saw a little bit slower growth in Q3, we saw quite an acceleration in Q4, which is overall certainly a positive sign, especially as we start to see some reversal in that export trend, and we're starting to see those increase. That's certainly good news from what we've been seeing over the past year and a half or so. So overall, the contributors to that, similar to what we've seen in the past, professional, scientific, and technical services had strong growth from a GDP contribution perspective, finance and insurance. State and local government actually had a more significant influence on the GDP growth than it's had lately. Some of the government components had slowed down for a while, and we saw an increase here in this quarter. And again, keep in mind, this is the Q3 data, so this is off of the 2.3%. We don't really have the detailed data for Q4 as of yet. So these are some of the key areas where we saw growth, pretty similar to what we've seen in the past, other than that shift in the state and local government. Accommodation and food services was up as well. Some of the places that were down from a GDP perspective, retail, trade, construction, which sometimes happens seasonally this time of the year. But wholesale trade and utilities were also down. Durable goods, manufacturing, a little bit contradictory data with what we see from a durable goods order perspective. And so, some of that we'll have to sort out what some of the implications might be. But overall, a number of places contributed to that Q3 GDP growth. Looking at the labor force, as we always do, we are continuing to see, the labor force returning to work, so to speak. In the past year, the overall size of the labor force, the civilian labor force, increased by 1.7 million. On the good news front, we actually saw 1 million women return to the workforce during the course of that year. Some of you may remember, in April, especially last year, we were talking about how so many women had left the workforce for a number of reasons, and we're seeing a bit of a reversal on that trend. So that's certainly good news. From December 2020 to December 2021, we did see an increase in the civilian labor force participation rates for both men and women. So that's positive news as well. If you look at the graph to the right, you can see kind of the civilian labor force versus the unemployment rate and how that's changed over time. We are continuing to see, positive unemployment numbers, especially in sort of the normal U3, the overall unemployment number that gets reported quite a bit. From a U6 perspective, still seeing, not as good a numbers there, but trending in the right direction. So overall, we're seeing a good, strong rebound from an economy and jobs perspective overall. When you look at reasons for leaving, and this is where we start to get into some concerns in terms of the data. Many people have heard the term the Great Resignation and things of that nature. And so one of the metrics that we look at is why are people leaving their jobs? So if you look on the left side of this graph, you can see the green bars, which were layoffs and discharges, were the prominent reasons for people leaving, in March and April of 2020, and slowed down, but continued to be strong. What you're seeing now is the blue bar, the quits portion, or people voluntarily leaving their job, is increasing in terms of the numbers of people and the reasons why they're leaving their job is more and more because they're actually quitting and moving on to different employment. When you start to look, over time, that number's hovered in the 3.75 million range. Now we're seeing that number tick up over 4 million into even the 4.5 million in terms of number of people per month who are actually quitting their jobs, and that's the reason why they're leaving them. So the Great Resignation is definitely a real thing. As we've been talking to clients and if we've been working with them over the past 6 months or so, we've seen in some cases people have their overall, turnover rates increase by double, or in some cases even triple in certain segments. We're seeing a number of very interesting trends. We're seeing a lot of people who are leaving for fairly significant increases in salary. 7 to 15% is not uncommon at all. Oftentimes significant promotions, especially a lot of younger workers who are getting significant career growth opportunities as they move on to the next thing. And it is really driving up turnover in organizations, and I know that's coming more and more to the top of the agenda for a number of organizations. We're seeing organizations who use strong predictive modeling from a turnover perspective doing a little bit better in some of these areas. Those who really have a good sense of their workforce and the turnover dynamics and are able to use some of those models are getting ahead of some of these trends, and they're not seeing quite the same uptick in turnover. They're having the ability to go in and do targeted interventions and really find ways to tamp down on some of that turnover. So they are faring a little bit better than some of their peers and others in their industry. But this is a trend that we expect to continue to see and probably will accelerate, frankly, in terms of quits being a high percentage of why people are leaving their jobs, and more of that Great Resignation wave moving forward. There's not one reason that really any of the research has been able to pinpoint behind the Great Resignation. It ranges anywhere from, the kinds of opportunities that I was talking about in terms of what people are getting as they move on to new jobs, to wanting to leave certain industries and move to other industries, to, lifestyle changes, relocations. A lot of things are driving that. And I think that we'll continue to see that multifaceted driver of resignations and of quits in the workforce until we get to sort of a new equilibrium. But I think from all the data that we're seeing, that's going to be quite some time. From an unemployment duration perspective, some good news on this front. We're continuing to see the overall duration from an unemployment perspective go down. One of the things that we look at in particular is the percentage of people who have been unemployed 27 weeks and over. That percentage continues to go down. So we're seeing good trends. We're seeing good data on the unemployment front in terms of the duration of unemployment. It's basically gone down from 4.2 million in March of 2021 to 2 million now in terms of the number of people who are unemployed over 26 weeks. So definitely a positive trend and something we're encouraged to see progress on. We started about a year ago looking at the household pulse survey results, and this is where we start to get into some mixed data. We see some slippage in certain categories, but when you start to look at more of the human factors and human elements that go along with some of this, food scarcity, one of the measures that they look at is households that haven't had enough to eat in the past 7 days. We did see a bit of a creep up in that to about 9.7%, where it had been around 9% for quite a while. We're also seeing from a housing insecurity perspective, things are bounced up a little bit. We had been down at about 5.9% in October, and that went up to about 6.4% in December. Many of you know there were a number of programs in place in terms of eviction moratoriums and things of that nature that have continued to expire, be modified, some of them challenged in court and things of that nature. And so this will be an area where we'll probably continue to see some fluctuation over time, but a lot of the protections that had been in place have either changed or expired in some cases. And so this number could continue to go up. You have different events, some of the fires that we had out here in Colorado, for example, create a bit of chaos in the market in terms of how some of these things play out as well. But that did tick up a bit. In terms of daycare options, the percentage of basically where children were not able to attend daycare was about 30%. And then adults in households where someone was able to work on site in the past 7 days, 58.8%, that's about what it's been. We expected those numbers to start to tick higher, but as we've started to see, additional waves of COVID from the Omicron variant, things of that nature, a number of organizations have either stepped back on their sort of full reentry, full reopening kinds of plans, or in some cases, or in some states, actually put additional restrictions in place from where they had been. This is very uneven across the country when you look at what policies are, both from a standpoint of different geographies as well as what different workplaces are doing. There's not a real consistent trend that I can point to and say, this is kind of how everybody's handling it. I had one client who was planning on pretty much a full reopening with, new policies and procedures in place, and now they've put that on hold given the, case numbers where they are. So lots of variation in terms of that, but I would expect that we'll continue to see this number in about this area for a while until we get a better handle on the trajectory of some of these of COVID and some of the variants that we're experiencing now. From a standpoint of job growth, we're still, if you look at sort of March 2020, the beginning, so to speak, of the pandemic to December of 2021, we're still at a net basically of 3.5 million jobs less than we had at that March 2020 perspective. It's interesting when you start to try to correlate some of these numbers, because on one hand we've had the civilian labor force increase in terms of the overall numbers of people who are in the workforce. We've had a decrease in the number of jobs overall, a significant increase, as you'll see in a few minutes, in the number of openings that are out there, but yet, some lower unemployment rates. And a lot of that comes down to how many people are, workforce eligible, so to speak, but discouraged in the workforce, not looking for work right now, et cetera. And so, these are all things that we try to sort through and get a handle on. I think from an employer perspective, it's still very challenging to get talent and get talent when and where you need it. And I'll talk about some of the strategies and things that we recommend to organizations based on that. But the bottom line in terms of this particular number is that we're still not quite to pre-pandemic levels in terms of the number of overall jobs that are out there. We still have a ways to go in terms of recovering to that point. So this just shows you over time how some of the jobs have been bouncing back and where we've been. So we have made some progress, in terms of looking at things over time, but from an overall perspective, we're still $3.5 million or 3.5 million jobs down. When you look at the gains in Q4 2021, the overall what we're looking at is goods producing had about 226,000 jobs, construction and manufacturing from a durable goods, non-durable goods perspective. Again, contrast that with the overall GDP numbers for durable goods manufacturing were actually down. But I'll talk about orders in a minute, and that explains some of that. When you look at the services sector, again, this has been the driver of growth for quite some time now, and it continues to be one of the major growth engines. So leisure and hospitality, that accommodation and food services piece, continues to be a big driver. Professional and business services is a big one as well. Some of these others have had smaller gains, but a lot of these correlate to the increases in GDP that we've seen in some of these sectors as well that I talked about a little bit earlier. So the jobs are flowing from there. State and local government, in spite of increasing their contribution to GDP, lost jobs in the course of this. That doesn't mean that they're not spending money and using contract services and things of that nature, but in terms of total jobs, they've gone down, even though their contribution to GDP has continued to go up. Oh, sorry, a little too far there. Okay, so job openings is what I wanted to focus in on. If you look at the green line, that shows the total number of job openings. That would be a really good line if that was your investment portfolio, but when you look at it from a job opening perspective, that's not necessarily such a good number. You can see the blue line, which is the 12-month moving average, which sort of, flattens that line a little bit, but suffice to say that we continue to see a lot of job openings out there. We see it in a number of different ways and how it's playing out in the labor market. For example, if you look at entry-level wages in some of the sectors that I talked about, whether they're food service or accommodation, retail, even gas stations, things like that, the prevailing starting wages have ticked up quite a bit. And that's very often what happens when you're starting to see this kind of high openings, labor competition, et cetera. But many of you have probably seen, even just from a practical impact perspective, inability to keep retail or stores or those kinds of things open, or having to modify hours, things of that nature. Even, I've seen out here in Colorado, some of the pharmacies, for example, no longer open. Some of the retail pharmacies no longer opening their pharmacy on weekends because they can't staff it. So they're only open during the week. Lots of organizations, establishments operating on modified hours, or going into restaurants and saying, hey, we can only seat half capacity today because we don't have staff. So it's very visible in terms of the job openings and the inability to really fill those jobs. And a lot of organizations are not getting as creative as they need to just yet. Many of them are still focusing on starting wages as a motivator, and that's not having quite the same impact as it's had in the past in terms of drawing workers to those jobs. So job openings continues to be one that is a potential inhibitor of economic growth as we look at some of these things, because when you can't staff shifts, when you can't have your establishment open, et cetera, it will obviously hit you from a financial perspective and cause economic concern. So more and more organizations, this is becoming very high on the priority list. How do we fill roles? How do we fill those pieces? And there's a lot to that. I'll talk about strategies as I always do at the end in terms of how you start to address some of these things. From a self-employment perspective, not a lot new here. Self-employment really has stayed pretty similar once we had a bit of a rebound. As the pandemic drug on, we had a significant reduction in the front end of the pandemic, but then as we went through, it sort of returned to more historical levels and continues to stay at that level. So it's an area that we continue to monitor, we continue to look at, but it's stayed pretty similar. I think that the story of how the self-employed are doing is a little bit more nuanced, and it's something that we're doing some research on now, and hopefully at the next one of these webinars I can give you a little bit more of a picture of that, because I think it's a little more uneven when you start to look at how are self-employed folks faring, and what's going on in terms of that actual um, economic outcomes, etc. From a small business pulse survey results, again, this is an interesting one. When you look at the left-hand graph, it looks at changes in the number of employees. So the black line is essentially the percentage that decreased their number of paid employees, and the green line is basically the number that increased their number of paid employees. And so the numbers who have increased have gone down, the numbers who have decreased have gone up. So this shows some overall weakening, or potential weakening, I should say, in terms of jobs in more recent history. If you look at that sort of trend from October to December of 2021. Be very interesting to see, given the acceleration in GDP in this most recent quarter, when this next round of data comes out, and we can kind of look at it from a quarterly perspective and start to see if we're seeing that more consistent increase in the numbers of employees. From a supplier delay perspective, good news there in terms of just some very slight downticks in people who reported supplier delays from a domestic and a foreign perspective. Not enough of a trend for me to really say, what exactly is behind that. Obviously, this has been a huge emphasis for many months now in terms of trying to, fix supply and get supply in better places. So we did see slight decreases in the number of businesses who were reporting supplier delays. So I'll cautiously say that's good news, and hopefully that trend continues as we start to go forward. Some numbers to think about, and I want to really dive into these for a few minutes. When you look at where we are from an annual percent change in hourly earnings, this is basically trying to look at what people are taking home. So in the past, those numbers have hovered in the 2.9 to 3.2% range. And so that those numbers are higher than that traditional sort of thing. I talked about labor shortage. Certainly that's helping to drive a number of these things. I think we've talked about in the past, in the pandemic, that there were, a lot of the lower paying jobs that went out of the workforce. We are seeing a lot of those back. So I think these are more real numbers than we've seen in past, and they are higher than, what it's been traditionally from a historical perspective. I'm going to drop down though to the bottom right-hand number, which is the consumer price index, which essentially is measuring inflation, and that's showing a 7% increase when you look at it. Those numbers have traditionally been in the 2.4 to 2.5% range. So when you think about that from an impact on people perspective, inflation has been in the 2.4, 2.5% range. Average wage increases have been in the 2.9 to 3.2% range. People were able to stay slightly ahead of inflation, depending on the geography and the market that you were in. At 7% from an inflation perspective versus a 4.7%, average increase in wages, you're obviously not keeping up at that point. You're losing a fair amount of ground when you start to look at that. So that's very concerning. There's been a lot of discussion, obviously, at the national level, policy-wise, around what to do about that and how to look at some of those things. But that number is concerning. And when you look at the drivers around the consumer price index, it's a lot of, core things from energy and food and all those kinds of things that kind of everybody buys. You do see some influence in that from the car market and things of that nature, which not necessarily everybody participates in, but overall, the increases from a price perspective have been pretty broad spectrum, and overall wages aren't necessarily keeping up from that standpoint. So important numbers that we continue to look at. When you look at the annual percent change in employment cost index, that's essentially what employers are paying overall for their workforces. It's a simple simplification. So, but that's at about 3.7%, and so that's looking at what employers are seeing in terms of increase of their employment costs. The consumer confidence index number has see a slight uptick from where it was the previous quarter. Some interesting dynamics there. When you look at what the conference board put out around this number, one of the things that they noted is that a number of households had increased their plans or created new plans for major purchases such as cars, appliances, things of that nature. Whether they're actually be able to find any, I don't know. But when you look at some of these things, that was starting to drive some of the confidence. And interestingly enough, from Q3 to Q4, there was a slight decrease in the number or the sort of the level of concern about inflation. Now, that's not saying much because in Q3 it had literally been at the highest it had been in 13 years in terms of people's concern about inflation, but that did go down slightly. I'm not sure what drives that. I haven't really seen any numbers to justify that necessarily, but the concern did decrease slightly. Same with people's concern about COVID and its impact. At the end of December, there was a slight decrease in terms of people concern about COVID and its influence on consumer confidence. The speculation that some of that is just fatigue and some of it is just, well, everybody's going to get it anyway and those kinds of things. I don't think we have the real hard data to say exactly why the decrease, but that did help increase consumer confidence overall for the time period that we're looking at. So some interesting numbers when you're starting to try to unpack what's happening from in sort of people's lives and how are they feeling about it. When you start to look at leading indicators, construction spending has started to rebound. We started to see that trend a little bit early, in the mid part of 2021, and then continued through the course of the end of the year. Sales of single-family homes, went through a significant increase and then started to decrease, and they've been bouncing a bit as you start to look at it. Across the country, there's a lot of variation from market to market, and some of the hotter markets have started to cool off and some not so much. So when you look at it, there's a lot of unevenness in the data here from a leading indicator perspective. Mortgage rates have increased a bit from where we were previously, about 3.45% now. Probably many of you have heard about the Fed raising interest rates in March. That will eventually have an influence on that housing market as well. So we'll see how the Federal Reserve's actions, what impact they really have from an inflation perspective, and how they start to move the needle from that standpoint. But housing is sort of leveled off a bit from its highs in terms of single family home sales, and with increases in mortgage rates that may further impact that. From a durable goods perspective, we're starting to see an uptick in durable goods orders. You saw there was a dip in 2020 right around the time of the pandemic, and we've been, on a more steady increase since, late 2020, and that continues. But, as I mentioned, some of those things did still see decreases in GDP, increases in jobs, et cetera. So I think the outlook overall from a durable goods perspective continues to be good, and we continue to see increases in that. But in some cases, there's some blips that we've seen from an overall economic impact, et cetera. So from a new business application perspective, you can kind of see the trend lines from a new business application standpoint. You're starting to see that they've leveled off a little bit. One of the questions that they ask when you're looking at new business applications is basically what's the likelihood that you're going to have employees, not just be, sort of a solo shop and that kind of thing. Right now, it's currently at about 33%. That's a number certainly that we'd like to see a little bit higher from an overall job growth perspective, and where things are from that standpoint. But overall, leading indicators continue to trend pretty well and in the right direction. So no major concerns from that perspective. In terms of looking at COVID-19 itself, very fast-moving data when you start to look at this. Very uneven when you look around the country in terms of where people are. You can see kind of the case numbers. This breaks it down by county and different geographies, but very uneven in terms of what you see around case rates, et cetera. And I think that a lot of different geographies are going through different stages at different times. And so from an organization standpoint, everybody's kind of having to deal with what they've got in terms of their geographies, their local and state regulations, all of these different pieces. One of the things, of course, that's on the mind of many organizations is, national mask mandates, and not just for federal workers, but for large businesses overall, all the challenges in court and, some of the shifting things around that. So a lot to deal with in terms of COVID response and what people are looking at from a standpoint of how to look at COVID. But from a case rate perspective, we are seeing a lot of unevenness around the country, and certainly that continues to have an impact from an economic perspective. One of the barriers that we continue to hear from workers in terms of returning to work is around COVID and COVID protocols and things of that nature. And I'll talk about that dynamic for a minute, because I think a lot of organizations are really struggling with this. We're seeing a number of organizations, public sector organizations, some larger organizations, et cetera, who have what I would call more place-based jobs, right? Jobs where you either have to go in every day, or it's an on-site kind of job, or something where the expectation is regular on-site work. Almost to the T, they're reporting, organizations that have those kinds of jobs are reporting losing workers to jobs where people can work virtually and work anywhere. And so, it started kind of anecdotally many months ago, and now is becoming something that we can actually start to see data and measure in terms of that. So there are some jobs that just require that you be there, right? And they're hands-on and things that you have to do in person. But it is becoming an additional headwind for organizations that have those kinds of jobs, where they're losing people to organizations where people can work anywhere. And it really goes from the full spectrum of employment as we look at it. As an example, many of the technology companies that we work with who maybe don't have as liberal policies around working from anywhere, those kinds of things, are reporting, losing large numbers of very talented, technology talent to organizations that have more liberal, more open policies in terms of remote work and virtual work and things of that nature. So these are becoming, a real issue and a real concern for organizations, and something they've got to deal with from an employment brand and overall attractiveness standpoint. Okay, so as we always do, I want to talk about kind of things that you should be thinking about today from an organization perspective, trends or things that you should be working on or looking at as you go through. So first is supply chain optimization, and really looking at where you are from a supply chain perspective and figuring out, how you can optimize that. I mentioned earlier that increase in investments in inventory. That's one strategy that people have taken in order to try to hedge against some of the supply chain challenges that organizations are experiencing. But more and more organizations are really taking a careful look at their supply chain and the reliability of supply, where they're getting supply from, et cetera, and starting to rethink that. Part of the reason I think that we're starting to see some improvements in, supply and less people reporting supply shortages or delays or things of that nature is because there are a number of organizations that started doing this months ago and are, seeing the benefits of trying to work through this. From a strategy perspective, number of elements that go into it, from sourcing and how they're doing the sourcing itself, down to looking at the location of suppliers, blend of supplier locations, etc., mixing more onshore, nearshore, and offshore strategies, shifting the mix around those, putting more, onshore and nearshore kinds of supplies, et cetera. So a lot going on in that particular space. And I think we're starting to see some improvements in places, but this really continues to and needs to continue to be, kind of top of the agenda from an overall supply chain perspective, and making sure that you get that right. Related to that, though, is really around this talent retention and talent competition. Um, I think I mentioned earlier just the great resignation, increases in turnover, losing critical talent to people who have different work arrangements, et cetera. There are a number of facets around this. I really am advising organizations to take a very hard look at talent risk right now, and where they are from a talent retention perspective, and get aggressive now about keeping the talent that you want to keep, because more and more organizations, frankly, are becoming aggressive in terms of going on offense around talent and looking for opportunities to steal key talent, trying to find people who may be, unhappy, or looking for new opportunities and those kinds of things, and being fairly surgical about it, frankly, in a lot of organizations, and trying to say, we know there are key market movers or high performers or those kinds of things in organization that is, that really are vulnerable in terms of losing particular talent. So the organizations who are addressing this proactively, I mentioned earlier, some of them have the predictive analytics to drive it. But even if you don't, there's a lot of things that you can do to try to identify potential risks and look at what you can do to save those folks and keep them engaged, et cetera. Money is not the only answer. And usually I say money is not the answer, but I will tell you that given where the market is now, money is likely part of the answer. Given the increases that we're seeing as people move from job to job, given the sort of offers that people are getting, especially key talent, money is probably going to be part of your answer. It's not uncommon, for example, in some of the data that we're seeing, for people to be seeing 15 to 25% increases from a wage perspective. Even if they like where they're working now, that can become pretty compelling to people, especially at different stages in their career. So when you're looking at talent retention and looking at talent competition, you have to look internally, and you have to take a very close look at what you're doing internally. Where are you competitive? Where are you not, across the full value proposition? So not just dollars, not just benefits, work environment, policies, advancement, all of these different components. Because as I mentioned earlier, the great resignation isn't about one thing. It isn't about just people moving for salary. It's about a lot of different things, and it's about that total employment experience. So I'll talk about brand in a second, but when you start to look at that full spectrum of what you offer versus what your competitors offer, you really got to look at the places where you need to shore up and where you need to make sure that you are competitive in order to keep that key talent. I can't emphasize enough how important that is to do now, because as we're starting to see these increases in turnover that I mentioned earlier, I think we're at the early part of that wave. So a lot of organizations who may have seen, a doubling in their turnover could see a tripling or quadrupling if they're not careful. So I think it's very important to address this piece now. That gets into employment brand. And when I look at employment brand, I'm not thinking of it just in terms of, how popular is your name, or how well known is your name, or things of that nature. That's not really as important as what do you offer, what is that value proposition, and how well do you deliver on that value proposition. Being able to get insight into companies and what the culture is and how they treat employees, et cetera, is nothing new. But when you look at the amount that people leverage that kind of information and intelligence in making their decisions about where to go, where to stay, et cetera, that's continued to increase. So brand management, employee value proposition management, et cetera, is really a critical capability, critical competency in terms of what organizations are doing. Many organizations through the course of the pandemic had their brand shift without them necessarily consciously trying to shift it. And in some cases, they may not even be fully aware of what impacts their policies, their approach to the pandemic have had on their employment brand. Every week, literally every week, I talk to organizations where they say, oh, I haven't seen my team in 2 years, or things of that nature. And when you start to think about the impact that that has in terms of perception of your brand and value proposition, et cetera, you've got to be very conscious about how you measure those things, how you look at them, and how you address them. So again, it's really important that organizations urgently look at where they are from an employment brand and employment value proposition perspective and optimize. Optimize in order to be able to both attract new talent and retain new talent. If you haven't done, a recent, meaning in the past 6 months, assessment of your brand against competitors and those kinds of things, it's important that you do that and really get a baseline of where you are, and then start to figure out what actions that you need to take. I really, it's part of the reason why I emphasize this is that, this is the time of year where we typically start to see turnover pick up. People get annual bonuses, people get annual commissions, people get those kinds of things, and then they start looking at, what am I going to do next? Am I going to stay here? Am I going to go somewhere else? So in my experience of doing this for 28 years now, this is always the time of year where whatever the trend was prior to the end of the year, it accelerates when we get into this season. So a lot of the turnover, a lot of the numbers that we're starting to see, I think, are going to continue to accelerate into that first quarter. And at the end of first quarter, a lot of organizations are going to be going, oh my God, what happened to me? So important to really address that now. Labor automation and contingent workers. I've talked about this one a fair amount in past webinars, but it is important to note that the pandemic has continued to underscore the importance of strategic labor automation and really making sure that you have the right contingent workforce in place, making sure that you have the right blend of internal employees and sort of outside labor, more flexible labor that you can leverage. But the labor automation piece is also a really important one. Looking at where you can strategically invest in reducing your labor force and doing more automated tasks and things that reduce your reliance on labor is really a critical component. This is one where we've seen a number of industries really go wholeheartedly into this labor automation, and they're starting to see real gains from it. Oftentimes they may have issues in other places, but from a labor automation perspective, we are starting to see improvements and lessened impacts of labor shortages in a lot of those places that focused on it. So optimizing that mix of who works for you full time, where's your flexible workforce, and what can you really automate is a really critical element. Again, if you haven't done that, if you haven't really taken a comprehensive look at that, I would suggest that you do. Lastly, and this is a new one that I'll talk about, is manager capability. Are your managers equipped to manage in the world that we have now? And unfortunately, in many organizations that I've been working in recently, the answer is no. And what I mean by that is when you think about a world where we do a lot less in person, we do more virtual, but there's also, a lot more uncertainty. Things change more quickly. We need different ways of engaging, our workforce and those kinds of things. I mean, it just really creates the need for a different set of skills and a different, set of competencies on the part of managers. And we haven't done much training at all, but we certainly have done a lot of training on those kinds of dynamics and the things that need to be dealt with there. So looking at manager capability, redefining what you want your managers to be able to do and how you want them to be able to do it along the lines of accountability, culture, engagement, things of that nature is going to be really important. Giving your managers the tools to effectively manage along those lines is also important. Giving them the right workforce planning to help understand where their workforce is, what their needs are going to be, how the organization's capabilities around talent acquisition, et cetera, are able to help them from that respect, giving them the tools to have critical conversations, to hold people accountable, to talk about development, to bring the resources that the organization has to bear from a development perspective. All of these things are really critical competencies. And a lot of organizations have not been investing in this over the past 2 years, but you're going to have to. It's not just a matter of, being able to have the current workforce perform. It's also a matter of being able to have the managers be a force in that retention discussion and that retention effort and keeping critical talent, having them be able to manage, more automation, more contingent workforce, all of the things that we talked about in terms of this, being better ambassadors for the brand and helping the organization really live the brand is also a critical component in terms of what managers can do. So for every organization, it's really important to sit back and strategically define what do we want our managers to be able to do in this kind of new world of work, and how well equipped are they to do that? How do we close those gaps? Some of it is going to be traditional training, but some of it is going to be more of the, on the job experience and the right coaching and mentoring and tools and things of that nature. So it's really a critical component. All of these different strategies that I talked about, the urgency is there now, and I think it's going to continue to grow for organizations. So it's a lot to look at, but at the same time, I think that many organizations are headed for, pretty significant challenges from a talent perspective if they're not careful and if they don't address some of these issues. So that gives lots of people things to do after lunch, but I will stop there and I will look at what questions we have.
Excellent. Thank you, Brian, very much for that. Questions have popped up here. And it kind of segues to this first one. The things you mentioned that companies should be focused on cover a very broad spectrum. What would be the priority? You covered quite a bit. Were those prioritized in any way, or if they weren't, could you please?
Well, I think the supply chain optimization one has a lot to do with what kind of business you're in. If you're in a goods-driven business, then I think that still stays at the top of the priority list. But I think beyond that, they are pretty much in priority order in a lot of ways. When you look at it, I think there's a very surgical look at talent and talent competition that has to be done, and then broadening that out to a broader conversation about employment brand. I think that the other two, obviously they're longer term in terms of making an impact there, but they're things that it's important to start to get a handle on now. So in a lot of ways, they are in kind of a priority order when you look at what organizations need to address.
Sure. Excellent. All right, here's another question from someone. You emphasize culture in a couple of these webinars now. Why do you see that as so important?
Well, I think that I talked about the Great Resignation having a lot of different elements to it, but a number of those elements, frankly, come down to culture. It's a lot about what is it like to work for your organization. Um, this has been changing for generations, but the willingness of people to put up with bad cultures continues to just decline, like you wouldn't believe. So, when opportunities are out there like they are now, I showed some of the numbers in terms of job openings, et cetera. When companies are getting much more aggressive about pay and flexibility and things of that nature, people feel like they have options, and if your culture doesn't measure up, their willingness to leave is much higher than it used to be. We're still collecting, some of the more empirical data on that, but just from what I'm seeing now is the willingness of people to leave companies, and the level of loyalty is really just gone down a ton in terms of, people are much more willing to jump from a place that they feel like the culture isn't good. So that's the reason why I really emphasize that. And I think it's also the anchor for a number of these other things. When you look at employment brand, when you look at your ability to attract and retain, culture is a key piece of that. It's also one that you can't turn on a dime. So I think it's one that organizations have to get ahead of and really make sure that they're addressing in from a very systematic way.
Sure. And I'm sure that's amplified because of what's been happening the past couple of years with COVID and kind of exposed some of those gaps there in culture. And it reminds me of the consumerization of the candidate, how they are now searching for culture, also satisfaction of their job. So can definitely see why that's so important now.
Yeah, there's no doubt, and I think that it's I really people are shopping for the total package, right?
Sure.
And it's not to say that, and this is an important point that I want to emphasize, it's not to say that there's one culture that's the right culture, right? Different people want different things out of culture, but making sure that, one, yours is a positive one, and that it has elements that are going to be attractive. So, there are some people who like a more stable environment that changes less, and that kind of thing, and that's good for some folks. Some folks want the constant change and those kinds of things. And so, defining who you are and that sort of thing, and making sure that the culture you have is a positive one. There's not one size fits all, but you do want to have the right elements in there to attract the talent that you want.
Absolutely. Excellent. Another question here from the audience. All of the data shows that wages are rising, and you mentioned it, but some company leaders still aren't convinced that we need to adjust. What would you say to them?
um, the data doesn't lie, right? I mean, I think that when you start to look at it, I think the problem that a lot of company leaders run into is that it hasn't hit close to home enough for them. They'll tend to look at, oh, so and so got a great offer and those kinds of things, but that's just so and so, right? But the truth is that those high increases in salaries, those, look at numbers like the average increase that people are getting when they're moving jobs versus when they're staying at their jobs. I think the last time I looked at it, it was like the average that people were getting when they moved jobs was in the 9 to 15%, and the average wage increase they were getting was in the 2 to 3% range. So, and that data is out there. So, I mean, you have to really ask yourself the question, is whatever we offer going to overcome a 15% premium in pay? Because if it's not, right, you've got to look at your pay, and you've got to look at those pieces. That's why, for the first time in this webinar, I've been saying, money is part of the answer, because things have moved enough that you don't have a choice. You've got to look at the money side of it as well, and make sure that you're at least in the ballpark. I can tell you that the companies that aren't taking a look at that a year from now are going to sorely regret it.
Sure.
I can tell you, and Sal, you've experienced this as well. Compensation reviews have been one of the most requested consulting services that we've had over the past 18 months.
Yep.
I mean, if I had 50 more compensation people, I could keep them busy. It's, the demand is just that high.
Sure. Yeah, I've definitely seen that this past year. One question here. We have a little bit more time left. Our management team is, this is a brave question. Our management team is all over the board with potential solutions. How do you go about getting a refocus theme going before we head off in another direction?
um, well, part of that is that many organizations have lost alignment over the course of the past year. The high percentage of virtual work and just a lot of those kinds of things haven't helped a lot of those things. But I would say that, you have to think about where you're heading from a talent perspective, just like you would your consumer brand, right? If you're all over the place and people can't figure out what you're doing, and there's no cohesion to your strategy and those kinds of things, it's going to fall flat, right? It's not going to have the impact that you want it to have. And so, making sure that there's alignment. And when I look at alignment, I really look at, three things that you've got to have going for you. One, people have to believe it, from a true, visceral level. They've got to believe that whatever strategy you're taking is going to work. The second, you've got to have some data to support it. You've got to have some data that says, yep, this is the right direction to go to, and have something to fall back in that respect. And the third thing, excuse me, the third thing is making sure that you're analyzing and course correcting as necessary. If you start to move down the path of a strategy and it's not working for you, don't just change because you feel like it's not working, but start looking at data, start looking ahead, start looking at, are there things we need to do to correct? Don't be so dedicated to a strategy that you shoot yourself in the foot with it.
Sure.
But that alignment is really critical, because just like any other, any kind of marketing and branding effort, it's got to be cohesive or else it's not going to work.
Yeah, the ability and the success of pivoting and recalibrating is important, definitely in this. One last question, we got 5 minutes left. One last question. Are you seeing any creative ways to retain key talent?
I think the most creative things that I'm seeing are, well, I'll talk about two. So one is more in the way of involvement and engagement, and really having people be more informed and more part of helping decide the future direction of the company. Um, I think for high potential talent, that's honestly been one of the uh, most powerful tools that I've seen to really retain those folks. The second that I'm seeing more and more, especially over the past 3 months, is a little bit more choose your own adventure or choose your own package kinds of approaches to retention. Um, Really having conversations with key talent about what is it that they want out of the work relationship, what is it that they want out of where their career is and where they're heading, et cetera, and putting together a package that sort of meets those needs. So rather than just saying, okay, we'll give you a raise, or whatever it is, it's kind of looking at the whole package, because different people have different values, and being more flexible in terms of putting together a package that is actually attractive to the person. I'll tell you the secret around that as well is that in many cases, the packages that people are creating when they engage the workers that they're trying to retain in the discussion often actually cost them less than they would have thrown at it anyway. So,
Right.
in many cases, the organization is sort of like, well, we'll throw this much money at the problem, but when you really talk to the person about what they want, it's not all that, right? It's not that level of money. It's some money, some flexibility, some of this, right? And in the end, the companies actually come out better and the workers are happier. So, there's value in engaging in that dialogue. But my caution is that make sure the people who are engaging in that dialogue are good at it. I talked
Sure.
about that manager capability piece, making sure they have the right people having those conversations who can really, build trust and build rapport with people, and get to true needs, and then work within the organization's systems to help fulfill that. I mean, it's a critical component.
Absolutely. Well, thank you very much. There are two questions here, two more questions. I want to be respectful of time, so I may just get to one of them. And it was the first one that just came in. And just rest assured, audience, if you asked a question, we will get an answer to you if we don't address it here. But we got 2 minutes left. Brian, great presentation. What are your thoughts on leveraging foreign craft workers and bringing them into the USA? That seems like a loaded question, to a longer
Yeah,
response
I
for
was gonna say
2 minutes.
there's a little
So
bit more to that, but
yeah,
so I
so
think,
go ahead.
yeah, the one thing I will say is that I do think that we have to be, we're going to have to get more creative about some of our strategies around, immigration and workforce and those kinds of things. I Most of the kind of political debate around it is a lot of theater, but there are some real issues that have to be addressed in terms of how we manage that particular piece. I also think, though, that we have got to have a workforce investment strategy, at least a regional level, not a national level, because we're totally messing that up. So, and we've been messing it up for many years across different administrations of different stripes. So I'm not pointing to one party or the other, but our workforce investment strategies are terrible. And we are not creating the workforces that our companies need. So there's a lot that can be done around that.
Thank you for answering that. There is one question left. We don't have time for that one. We will get an answer to this individual. It's a great question. Brian, thank you for the time and effort that you and the consulting team put into providing this content today. Audience, if you have any questions or if you need any support for your HR initiatives and projects, please reach out to us. We'd be happy to help. On behalf of Brian, HRQ, and Landrum HR, I'm Sal Vergara. Until next time, elevate yourself and those around you.